Hello and welcome to the Family Office Network's webinar series. Today's event is hosted by tZero, a leader in financial innovation and liquidity for private companies, and will explore enabling private market liquidity through digital securities. Today's webinar is divided into 3 sessions. First, a company introduction and overview, followed by a panel discussion on the advantages of enabling liquidity of private assets. And last but certainly not least, a keynote presentation on the future of investments and trading. Each session will be followed by a brief Q&A. Please note that attendees' microphones are muted throughout the event. To submit a question during the Q&A sessions, use your questions chat functionality on the right side of your screen to submit over your questions. We will do our best to try to address as many questions as possible, and we'll follow up with anyone needed at the end of the presentation. I would now like to turn it over to Salman Tesfaye, tZero's Vice President of Business Development and Capital Markets, to kick off the first session. Salman, I'll let you take it from here.
Thank you, Lindsay, and thank you all for joining to discuss tZero and how it enables private market liquidity. I'm Salman Tesfaye. I'm the Vice President of Business Development and Capital Markets here at tZero. My background is primarily comprised of investment banking, operations, as well as venture capital. I'm joined by two of my colleagues, Ashu Vats, who's the Director of Business Development and has a background in investment banking and operations from Barclays and Goldman Sachs, as well as Ryan Zega, who joined from Paramount Group, a publicly traded REIT. Turning to the next slide. In short, tZero's technology digitizes, enables digitization of private ownership within a private asset or private company, and enables it to trade on our regulated trading platform. Currently, there's a significant liquidity gap between a private asset and a public asset. tZero addresses head-on and enables private assets to trade as easily as shares in Tesla. Turning to the next slide. tZero consists of a deep bench of technical and financial talent. Currently, we are comprised of about 90 employees. That's roughly split between technology and capital markets. We felt that it was very important to combine traditional capital markets professionals with this deep bench of technology professionals to ensure that this proprietary technology can actually be applied in a practical and compliant manner. On the next slide, tZero's technology has actually been tested at scale. Currently, through our subsidiaries, the technology supports routing execution of over 10 billion publicly traded shares, which equates to about 1.5% of the traditional equity markets, and we service about 150 broker-dealers. Additionally, it also operates our private secondary market platform, the tZero ATS, which we will elaborate on a little later in the presentation. On the next slide. So there are a number of benefits to actually digitizing a private asset and enabling it to trade. Naturally, investors are able to now access liquidity optionality. Additionally, through our technology, we're actually able to customize how the actual liquidity is facilitated on our platform. An example of this is we're able to enable liquidity within a specific jurisdiction, only amongst accredited investors, or even if you like no individual investor to actually accumulate over 20% position within your particular float, we're actually able to provide that flexibility as well. Additionally, there's a number of efficiencies that are gained through trading on our platform. One, we have automated compliance. Additionally, we have streamlined administration, as well as it actually streamlines the distribution of any dividends that you enable in the actual offering. Additionally, access to the actual investment opportunity. By actually trading on our platform, we actually have a significant number of international investors within our ecosystem. So it broadens the pool of actual investors that are aware and are able to invest in your particular asset trading on our platform. Going to the next slide. As I touched on the previous slide, there's a number of benefits to both you as the issuer as well as investors that are looking to actually invest in your particular offering. From an issuer perspective, you're able to actually capture a liquidity premium potentially by trading on a platform, which you've seen with previous issuances on our platform, reduce your cost of capital, given the fact that you are offering investors liquidity optionality, and also increase your optionality around financing flexibility. But in an investor perspective, you gain liquidity optionality, allowing you to move in and out of private assets on a semi-frictionless basis. The next slide. There are really two options to trade on our platform. Option one is a direct trading, which is very similar to direct listing, where there's no capital raise component to this. You're simply looking to give your current investors liquidity optionality. And so we would simply digitize the equity and the ownership allocation within your current capital structure and distribute the securities to those respective investors and onboard them into our trading ecosystem to trade amongst themselves and amongst the broader investor community. Option two is a digital security offering where you intend on doing a private placement and are seeking to have that private placement trade on the back end on our platform, or having the full equity stack within a particular capital structure trade on our platform. Just to elaborate on option one, can we turn to the next slide? Option one begins with business, legal, and reputational due diligence. This should be quite standard in terms of what we request. We're happy to provide as a follow-up what our ATS qualifications as well as our due diligence outline looks like. Then after the initial due diligence, we are able to digitize the actual equity within your particular asset, as well as distribute the digital securities, and then onboard those investors into our SEC and FINRA regulated alternative trading system. Once on our platform, investors are able to trade their positions within your particular private asset amongst themselves, amongst the broader community. And then there's also a semi-annual and annual disclosures that are required to trade on our platform to ensure that investors understand what the intrinsic value is of that particular asset. We also offer annual compliance checks to ensure that the asset is always within compliance, as well as continue to monitor to ensure that we provide any issue that's on our platform ongoing support. With that being said, I'm going to hand off to Hubertus to elaborate on option two and discuss a number of other points.
Thanks, Solomon. So taking a look at the next slide, thanks, Alex. Yeah, so the key difference in this process versus what Solomon just discussed around direct trading is essentially the capital raise. Most of the time commitment for the issuer during this process is related to actually raising the capital, and it can take anywhere from 2 to 3 months. The actual digitization process, which is where tZero's main role is, of the securities itself, is fairly quick and efficient, and I'll highlight that over the next couple of slides. So taking a look at the next slide, the goal is going to be essentially a step-by-step in terms of how do you actually digitize your securities once you're raising capital. So step one is for the issuer to determine what asset they want to digitize. Given the power of the tech platform and the technology, there's a broad range of assets which can be digitized and traded on tZero's ATS. For example, a real estate company could trade an individual building or a group of buildings. An asset manager, it could be a fund. And for a lot of corporates, it's likely an upcoming capital raise if it's not the direct trading option like Solomon just discussed. tZero works hand in hand with the issuers to determine, which assets have the right profile to trade on our platform. Once an asset has been identified by an issuer to raise capital for, the issuer moves on to step two, which is where we highly recommend they work with an established placement agent and law firm to help with the structuring of the offering. tZero has a great deep and network of partners. We're happy to facilitate introductions to placement agents and law firms, but it's not a necessity to actually have a placement agent in terms of helping you raise the capital. A lot of the management teams, within our pipeline are raising capital themselves. During the structuring phase, a lot of key decisions are made around what type of capital raise the issuer will be doing. What are some of the attributes of securities? Will there be a dividend, potentially a revenue share? What type of voting rights? Things like that are determined ahead of time. And once they are determined, a marketing strategy will be decided between the issuer and its advisors in terms of which investors could be interested in the offering. So moving on to step three on the next slide, we'll dig in a little bit into the actual capital raise itself. And I don't want to spend too much time here as your bankers and lawyers we'll go through the various benefits and considerations of each type of raise. And folks on the line likely are familiar with all of these, but from our perspective, most of the issuers in our pipeline who are raising capital are pursuing a Reg D, a Reg S, or a Reg A offering. Reg CFs, even though the regulators have increased that funding amount from $1 million to $5 million this year, are still tend to be a little too small for our platform. But we do see some of our issuers doing this in conjunction with another type of offering. From a tZero perspective, we don't have any specific restrictions in terms of the capital raises we see on our platform. I would say our only requirement is that the capital is raised in line with all rules and regulations. So moving on to the next slide, which is our last two steps. Step 4, once the capital raise has been completed, this is where tZero really steps in. And as Solomon went over, we'll go through business, legal, financial due diligence with our technology team. Our tech team is the one who's going to be spearheading the charge around the digitization process. Typically, once a capital raise is completed, we'll take the list of investors who participated, make sure they have their wallets and brokerage accounts all set up, and then help distribute the digital securities to their respective accounts. And looking at step 5, depending on the seasoning period, again, which is dictated by securities laws, these are not tZero requirements in terms of lockups. We'll work with the issuer in terms of issuing a press release announcing when trading will begin. We typically like to give the market a 1 to 2 week notice before a security begins trading, so investors are aware and can create an account to access the security before trading kicks off on our platform. Once we hit the trading date, and we'll work closely with the issuers and the investors, keeping them up to date on price activity, liquidity, what we're seeing in terms of just activity in general. And we make sure to support the issuer and the investors, during their time on the platform. So as you can see, this digitization process is fairly efficient. I would say, 2 to 3 months for the capital raise, and likely if diligence goes smoothly, it's, probably a month, in regards to getting everything aligned, getting the wallets and brokerage accounts set up, and then getting the securities to the respective investors. And tZero is, very proud of being able to provide white glove service, throughout the whole process. What we want to do next, and I'll hand it over to my colleague Ryan, is go through a recent case study to give you an example of what the process looks like a little bit further. Ryan?
Ashu, thank you for handing it over. We wanted to walk through the process and timing of a recent example of a digital security offering. In August of this year, we began trading equity interests of the St. Regis Aspen Resort, a 5-star year-round destination hotel prominently located in Aspen, Colorado. The resort features 179 rooms, 4 food and beverage outlets, an award-winning spa, and a host of additional amenities. The property was originally constructed as a Ritz-Carlton in 1992 and purchased by Starwood as part of its acquisition of ITT Sheraton in 1998. Then, in 2005, the property underwent a substantial renovation and rebranding under the St. Regis flag. The property itself was split in two, with a portion being the St. Regis Residence Club and the other being the aforementioned St. Regis Aspen Resort. On the next slide, the sponsor, Elevated Returns, purchased the St. Regis Aspen Resort from Starwood in 2010 for $70 million and entered into a long-term management contract. Elevated Returns is a full-service real estate firm that is focused on value-add opportunities in the United States, Southeast Asia, and Europe. The sponsor has a strong commitment to digitization and has a pipeline of real estate assets in excess of $1 billion targeted for future digital security issuances. Shortly after purchase, Elevated Returns embarked on a comprehensive $50 million capital enhancement project. The sponsor's strong management and targeted improvements resulted in hotel performance dramatically improving. Elevated Returns initially considered taking the St. Regis Aspen Resort public via a single property IPO, but ultimately decided against it. The IPO process would have been costly, onerous from a financial reporting standpoint, and it was uncertain whether the property IPO would garner enough investor interest. Instead, in 2018, Elevated Returns opted to conduct the Reg D 506C offering for an 18.9% equity interest in the property, which would then be digitized. Through digitization, investors in the Reg D offering would have access to a high level of liquidity that would otherwise not be available given the asset's unsuitability for an IPO. The asset was onboarded post a regulatory lockout period, and investors gained the ability to sell a portion or the entirety of their stake. The offering also received outsized press attention, with retail investors being able to participate in the offering on the secondary market. Traditionally, these retail investors would not be able to participate in an asset of this magnitude. It was also not only the LP investors who benefited from this process. Sponsors are able to highly customize the structure of these digital security offerings, offer streamlined distribution and reporting, and maintain control of the asset. On the next slide, we announced our partnership with Elevated Returns in July of this year to enable the St. Regis Aspen Resort digital security to trade. The press release received over 350 million impressions, which equates to roughly $3.5 million of ad spend. Both Elevated Returns and tZero received a high number of inquiries regarding the asset. Over the next few weeks, our team digitized the existing capital structure, provided technical support for the onboarding of the existing investors, and did a number of other house cleaning items. It was a very efficient process that was executed in a streamlined timeline and shows how quickly liquidity can be accessed through our platform versus traditional routes. Finally, on August 24th of 2020, the asset commenced trading on the tZero ATS under the ticker symbol ASPD. ASPD did about $200,000 of volume on its first day. Since then, pricing continues to be slightly above its pre-COVID valuation, which was $262 million or $1.46 million a key. The St. Regis Aspen Resort is an excellent example of a high-profile real estate digital security. We are actively working with a number of other institutional quality sponsors, including several family offices. My colleague Solomon will provide additional detail on our pipeline.
Thank you, Ryan. So what is the profile of an asset that would be appropriate to trade in the tZero private secondary market platform? So we are seeking to provide liquidity optionality to attractive assets, whether it be individual real estate assets, portfolio of real estate, whether it's operating companies within technology, industrial, healthcare, consumer. Right now in our current pipeline, we're seeing assets within a wide range of different industry verticals. And in regards to size, we're really looking for an equity flow of 10 million of equity and up. Our investor ecosystem does include a lot of family offices, hedge funds, and so forth that are moving significant amount of capital around. So we do want to make sure that there's enough available equity on our platform to enable trading. If you are looking for option one, where you're looking for a direct trading or direct listing onto the tZero platform, we will look through the capital structure to make sure that we feel comfortable that it's adequately fragmented ownership so that it is conducive for secondary trading directly on the platform. But if you have any doubts regarding whether your particular asset is appropriate to trade on the tZero platform, do not hesitate to reach out to us at sales@tZero, and we're happy to evaluate and do an initial due diligence on the asset and be very transparent whether we think the investor community would be receptive to your particular asset. With that being said, we'd like to open it up for questions. Alex, can you please coordinate that?
Thanks, Solomon, Ashu, and Ryan for kicking off today's event with an overview of tZero and how the company enables private market liquidity through digital securities. As Solomon mentioned, I'd now like to open up the discussion to the audience for our first Q&A session of the webinar. Please feel free to submit your questions through the platform's question widget. Our first question is, how does tZero feel they compare and will compete with other offerings of competitors who are already offering digitized securities trading? Solomon, I think this would be a good one for you.
Absolutely. So a lot of the competitors that I think you're alluding to that offer just the digitization of securities, they're not actually offering a marketplace. A lot of them are simply digitizing the actual asset, but naturally to actually ensure that there's actually liquidity, you need buyers and sellers. Currently, our tZero reflects about 95% of the global volume within the space. We trade about $1 million USD per day, and that's only been doubling or tripling each month. So in terms of actually not only digitizing the asset, but also offering a marketplace we cover both bases.
Thank you, Solomon. Another one that might be appropriate for you to answer is, what is the volume of ASPD? Can you elaborate on this?
Yes, Ryan, do you have the latest numbers on that?
So yeah, so the volume itself kind of differs day to day. I don't have the exact volume. The first day we did about $200,000 of volume, and it sort of, kind of differs depending on market demand. But pricing has remained fairly consistent, slightly above its implied pre-COVID valuation.
And just to elaborate on that, we're seeing in terms of monthly volume relative to market cap, about 4 to 8% for the Aspen resort. So in terms of churn, we've been very pleased with how that has been progressing. They put about 23 million of equity on the platform. So in terms of a monthly volume relative to market cap, that's how we tend to evaluate any individual security that's trading on our platform. We have been pleased with the performance of that asset as well as the issuer.
Thank you, Ryan and Solomon. I think we have time for one more question. How is an asset listed on tZero? Is it not considered a publicly traded security?
Ashu, would you like to elaborate on that, and I could add any additional points?
Yeah, no, it's a great question, and the way these assets are traded, if it is associated with a capital raise, it's usually a private capital raise, which is using Reg D or Reg S offering and has the exemptions which a typical public company would need around financial disclosure. So that actually makes our platform a little bit more, significantly more beneficial in terms of the burden around financial reporting and the exemptions we have versus going the IPO route.
And just to elaborate on that, we operate within the existing regulatory framework. So there's already, Rule 144, there's 487, there's a number of actual, regulatory rules in place that we align with in terms of facilitating liquidity of any of these private assets. So these assets remain private, yet we're actually able to, in a compliant manner, allow these to trade on an SEC FINRA regulated trading system, an alternative trading system. So basically the burden that comes with being public around the disclosure is somewhat diluted given the flexibility that the SEC has provided around what the disclosure looks like. So typically issuers on our platform offer semi-annual and annual disclosures, typically includes unaudited financials and so forth, and we're happy to provide foresight regarding what the disclosure requirements are, but they do actually remain private when they are trading on our platform. And we actually have Computershare, who's the largest transfer agent in the world that has about 40% of the market, that keeps real-time tracking of the actual ownership structure so that any disclosure that you need to provide to investors that participate in that asset, you're able to do so to their appropriate recipients.
Hey, Alex, there's one question I think, Solomon, it might be worth you referencing is, there's a question around, or that was asked earlier on, around are pre-revenue companies eligible to trade on the platform? I think, a little bit of insight on that would be helpful if you want to take that.
Yes, so just given the equity minimum that we're looking to facilitate in terms of exposure on the platform of 10 million and up, and then the fact that right now we are taking a more conservative approach around what type of assets we're willing to support. The assets that we are willing to support are commercialized assets, but if there's any, there may be some exceptions along with that. So if you have any specific questions, feel free to send over any material related to the asset that you would like reviewed, and we're happy to review it in more granularity. But in terms of the majority of the assets that we intend on working with, they are commercialized. And then I guess one comment about real estate, we're working with both real estate that's in current development as well as already built real estate that has historical financials. So we have worked with a full range in the real estate side of things.
Thanks, Ashu and Solomon. We've received a number of questions. If we're not able to get to your question in the next 2 sessions, our team will follow up with you to provide more information this week. I'd now like to shift to the second portion of today's event, a panel discussion on advantages of enabling liquidity of private assets. I'd like to hand it over to the moderator of the panel, Ashu Vats, tZero's Director of Business Development and Capital Markets.
Thanks, Alex, and good afternoon, everybody. Thank you for joining. I see Alan and Mike. Do we have Hubertus? There. Hey, Hubertus, how are you?
How you doing?
Excellent, excellent, excellent. So for those of you just joining, as Alex mentioned, my name is Ashu Vats. I'm Director of Business Development and Capital Markets here at tZero. We're excited about our next segment. This is a panel discussion on the advantages of enabling liquidity of private assets. On the previous session, you've already heard about what is a digital security and how tZero can help provide a liquidity venue for these private assets. But we want to dig a little bit deeper during this discussion and understand what are the real advantages in pursuing this route. We have a great set of panelists today. I'm going to quickly introduce them, and then I'll have them give a brief background on themselves. So joining us first, I'd like to introduce Hubertus Thonhauser. He's board chairman of Tezos Foundation. He's currently joining us from Dubai. So good evening, Hubertus, and thank you for being here today. We also have Michael Gaviser, who's a senior advisor and former KKR managing director, and Alan Konevsky, who's tZero's chief legal officer. And the thing I want to start with, in addition to your backgrounds, is none of you, as you can see from the bio page, are pure play technologies or these digital security junkies that you typically come across. You guys all have more traditional backgrounds. Can you guys, each of you, and Hubertus, I'll start with you, and then Alan, I'll move to you, and then Mike, I'll come to you last. Can you give us a quick overview on your background, just 1 to 2 high-level bullet points on your experience, but I think most importantly, spend a little bit of time on what attracted you to this space. So Hubertus, I'll turn it to you first, then Alan, if you can take it after Hubertus.
Yeah, thanks, Ashu. Pleasure to be here. Good evening or good morning, everybody. So my background is in technology and finance. I was actually in my early career building a gaming company in the casino space in Europe. I was CEO for this company for 10 years. It's one of the largest casino operators in Europe. After that, I built my own gaming company in the mobile game space, which was acquired then a couple of years later by an industry leader from Sweden. And then I started together with my family office to invest in the early stage venture capital and build up a portfolio with my fund and with my partner over the years. And the digital security space and generally the blockchain technology space attracted me because I was always interested in technology and frontier businesses. And I think what we've seen here is not only a technological shift, but it's probably also a paradigm shift in accessibility of investments to a broader audience, which was so far locked to a few wealthy institutions, individuals. And I think that's very attractive even for the latter institutions because they get liquidity. But we come to that point probably later. But that was something that attracted me to that space.
Alan, please.
Terrific. Thank you, Ashu, and delighted to be here. And thanks to everyone who made time to join us. I'm Alan Konevsky. I'm Chief Legal Officer at tZero. Been with the company for a couple of years, and I came here after about a 20-year career in a handful of places. And my focus was always financial services and capital markets, highly regulated industries, technological innovation. One of the folks I worked with towards the beginning of my career was a company that was an early innovator in electronic trading. So that's when trading moved from floor to electronic, which is probably kind of the prior node on the evolutionary chain of capital markets. And so for me to look at an opportunity set that tZero presented, both from a perspective of providing secondary liquidity for private assets generally, as Hubertus described, as well as from the perspective of providing access to blockchain functionality, whether for private assets or public markets, and our footprint tracks both. To me, that presented a unique opportunity, and I think the company, was an early innovator in that space. It was the one that did the right thing from a regulatory compliance perspective from the beginning, and I think its leading track record, including all the hurdles that it has managed to clear, whether from the regulatory licenses it has and the businesses that tZero operates or others, has been is a terrific achievement.
Excellent. Thanks, Alan. And Mike, last but definitely not least. I think you might be on mute, Mike.
Am I good now? There we go. So, as mentioned, I spent my career at AllianceBernstein and at KKR. At AllianceBernstein, I led the alternatives effort, and one of the core focuses of that effort was how do we bring new investment products to kind of traditional investors and institutional investors. And then when I went to KKR, it was really about democratizing what we did at KKR to reach other groups, and specifically kind of not just your traditional institutions. And what really attracted me to tZero is the reality is the private market is massive, and it's actually way bigger than public markets, but transacting in the private market is incredibly difficult. And tZero is the first solution I've seen where they not only addressed kind of the plumbing of transacting, but also the cost and the access. And so bringing those things together was super interesting for me to be able to partner with them in finding new solutions to enable more liquidity in private assets, which frankly is really the thing that private assets need. And the only reason I believe they're materially undervalued relative to publics is because they don't have the same liquidity.
So Mike, keeping with you, and you touched on this a little bit in your background, Solomon mentioned in the previous session, even though the traditional IPO market has been very active this year, the data clearly shows that companies are staying private longer, and a number of private raises has increased. And you just touched on liquidity, right? Liquidity remains, front of mind for investors. What are some of the key considerations, if you can tap into your previous life at KKR and at Alliance, in terms of things investors face when considering private investments and thinking about liquidity?
So to that liquidity point, there's actually tons of liquidity in the private markets from a funding perspective, right? That's the reason people don't go public anymore to the same rate, is because the need to go public to raise capital is not kind of the gating item. There's plenty of people funding. The reality though is for kind of the next leg, getting into that market and transacting is really tricky. And that's largely because of kind of the narrow nature of who's participating. And as you broaden that pipe, you actually get better valuations, because if you look at any asset that's privately traded and move it to publicly traded, you see actually, because of that lack of liquidity changing, valuation goes up. And so, I look at it and I see from my experience, if you can get interesting product, interesting alpha generating investments into the hands of people and provide them with ways to actually harvest that alpha, both from a mark to market, but actually a liquidity perspective, then you've really got something. And so this platform really allows you to do that, because suddenly you can take something that was in the hands of few and put it in the hands of many and usually that ends up being at a higher price point.
Right. So sticking with that, and Alan, Hubertus, putting it in the hands of many, right? A big thing you continue to hear about this space is democratizing access to these securities. Any additional thoughts on what Michael was just talking about regarding this?
Yeah, I mean, the aspect of valuation is certainly an interesting one. I mean, that's the interest of every investor, to get decent valuation. We're still in the early stages of that technology, but I think what we also need to bear in mind here, we are seeing also a generational shift in the utilization of access to capital and of investment thesis. So I see many family offices that shift over to the next generation, hand over to the next generation. I think they have a different appetite to deal with digital assets, and they have less barriers to entry to these kind of technologies. And I think they get more comfortable with dealing, not on the traditional markets, but in these kind of digitized areas. And I think that it additionally creates some sort of additional liquidity that will help the platforms like tZero to deliver.
Yeah, excellent.
Yeah, and I would second that. I think Hubertus, talked about generational shifts, and that's absolutely right. Another one is a generational shift, and it really comes on the heels of, the financial crisis, about 12 years ago. So, and events that followed, and that really is, a healthy dose of skepticism when it comes to the role of institutions and the role of institutional approvals and institutional perspectives. And that bleeds across a number of areas in our society, for better or for worse. And that it does touch capital markets as well. And so the same perspective of, well, wait for the asset to come public, and when a blue ribbon investment bank takes it public and it's trading on a blue ribbon stock exchange, that's when you really can invest it, but not before that. Before that, it's for somebody else. That kind of a story doesn't work, and it shouldn't work. And the reality is, Ashu, as you and Mike talked about before, there's a lot of value creation, a lot of interesting assets that are in a different part of a life cycle. They may stay in that part of a life cycle and not get to public markets for a long time or forever. And the narrative of that's for you, that's for somebody else, doesn't work anymore, and it shouldn't work.
Yeah. So Alan, sticking with you, clearly we've discussed there's a need for some form of liquidity and demand for it. You being at tZero for a couple of years now probably have a good sense in terms of what the landscape looks like. So what does the private secondary market landscape look like today? We know that there's multiple players who are trying to enter and operate within the space, but who's actually really focused on providing that dynamic trading environment for this asset class?
Yeah, look, it's a great question, Ashu, and I think the answer is that secondary liquidity for private assets is balkanized, expensive, slow, opaque, limited price discovery, limited information, and that's when it works. That's when it works and when it's available.
Right.
And so, kind of to be honest, all summed up, Mike Gaviser said a little while ago, it's hard, and it is. It's hard when it works. And so, there's a lot of capital, and again, it's not availability of primary capital. It's once capital gets there, what happens to it, and what happens to investors who don't have access at the primary stage. And the answer is that if you want to sell something, if you're able to, or if you want to buy something, if you're able to, there's largely this ecosystem of trade by appointment on the basis of very significant settlement delays, dealing with waivers of contractual transfer restrictions, high transaction costs, intermediaries with potential asymmetric access and information compared to other investors and participants. And so it's, if you look at, if you go from an efficient markets hypothesis perspective on this, and you think about the public markets as generally getting to the right answer, just from that perspective, the private markets don't. And then to some extent they can't, because there are a lot of hurdles. A lot of these are just legacy hurdles and legacy limitations and legacy layers of intermediation and interest and self-interest that we talked about before that folks don't and shouldn't accept anymore. And so, if you offer continuous, automated, transparent trading of these assets, that's a game changer, because otherwise you either don't have access to it, you have access to a balkanized, inefficient system, or you have to go through a fund and pay carry and management fees if you want to have access to some of these types of private assets.
Yeah, and it's a global liquidity, and it's available 24/7. That's also what the stock markets then deliver. So that also creates additional velocity potentially.
Yeah. So, Alan, kind of sticking with what you that was helpful. Thank you, Hubertus. But Alan, sticking with you a bit, talking about what this market has to offer. If we think about efficiency in public markets versus private markets, what makes this more attractive from your perspective?
Look, I think, having a continuous automated trading platform where private assets can be offered for sale on the basis of appropriate level of disclosure in a compliant manner with a transparent order book and transparent pricing information, transparent pricing history, reasonable expectations about how your trade is going to be executed, how it will settle, and what your rights are as a security holder, both from an economic and governance perspective. And that's and the same thing for an owner of that security or a seller as well. What your exit strategy is and can be. Again, I think it's a game changer, and so I think a platform like ours that provides an ability to do that and that utilizes distributed ledger technology, and again in a regulatorily compliant way to automate as many of these functions as we can, and it's a journey, is a game changer.
So on the technology point that you've referenced throughout, Alan, Hubertus, I'll turn to you because Tezos is clearly a leader in this space. How would you say technology in general has helped increase access to these private offerings?
Yeah, I mean, the underlying technology that you're referring to is the blockchain, is distributed ledger technologies. And the nature of that is that obviously it leads to an immediate term efficiency gains and cost savings when you apply it correctly through platforms like yours. I mean, it's basically an automated, frictionless compliance throughout the life cycle of the assets that you achieve. You have audit readiness forever because the blockchain is immutable, which is a very important aspect when it comes to compliance. And you have also, facilitate a real-time capital management for investors' information, which is also immutable and can be kind of managed in a compliant way. You have the economic upsides and market shifts that we discussed, which are facilitated through the blockchain technology, and you reduce the edge case risks as well. So, for instance, you create 100% certainty around the ownership of an asset, of the rights and provenance of the asset. You reduce the risks and the kind of costly and often time-consuming disputes around ownership and related litigation. And a fully automated compliance reduces also the odds of high-stake costs and compliance matters and the legal costs and all these kind of things. So I think the underlying technology is not something that should be the main focus for the investors in these assets. I think the less you speak about the technology, the better it is. This is something that tZero and technology providers need to think about. But the goal is really to provide frictionless and user-friendly interface for the end users with a top UX, and the blockchain technology that powers all that is basically invisible, like the internet is invisible to anybody who uses today's smartphone applications or, I don't know, streams videos on Netflix.
No, that's an excellent point. And again, I like what you had highlighted. The technology is not the driver here. It's a very helpful and it's a key platform, but liquidity and the fact, to what you had said, Hubertus, around the experience is what needs to be focused on. I think the gorilla in the room there, and I want to stick with you, Hubertus, on this. Both from the first presentation and here is, and we touched on it in a lot of your responses, but what are regulators' perspective on the space? I'm sure you're dealing with them, Hubertus. Alan, I want to hear from you. You're the lawyer on stage today, so I want to get your perspective. What are their take on the space? How does it compare to how they're treating this to the traditional world? Hubertus, why don't we start with you, and then Alan, I'd love your thoughts as well.
Yeah, I mean, we invested in a couple of these projects around the world. One of them you mentioned before is elevated returns. So I see that what the regulators in Asia seem to move faster on that front. So for instance, Thailand, they already established from the Thai SEC a full regulatory framework for digital securities, which is basically accessible to retail clients, so makes these products accessible to retail clients in Thailand as well. I think Thailand is the first mover here. Europe, countries like Switzerland, they try to catch up, and the US will follow. I mean, the US, you still have the 1932 Securities Act, which kind of is in place, and but I'm pretty sure the US will follow, and we can already see it. I mean, the adoption will be driven by institutions who invest into the space, and I think the SEC will follow that pretty soon.
Yeah, I think Hubertus gave a terrific kind of overview of where we are globally. There's obviously a difference among geographies. Some are more forward-leaning, some are less so. To some extent, there's some regulatory competition going on across a couple of countries, particularly in Europe and in Asia, in terms of providing very kind of blockchain-friendly and private securities-friendly ecosystems. In the United States, I think the view is that the existing framework for issuing, trading, and settling securities, whether to the public or in a private transaction, exists. If it's a security, you can structure a transaction that fits within those limitations, and we've talked about private placements in the earlier, for example. If you're looking to introduce additional levels of blockchain functionality into the securities life cycle, whether at the issuance, record-keeping, trading, settlement, or compliance stages, I think the path on that has been gradual. We've been one of the earlier adopters in that space, and in issuing securities, including SEC-registered securities that use blockchain to provide informational transparency into an issuer's capital structure. We've talked about opaqueness before, we're looking to continue to innovate. I think the SEC and SEC leadership has been making very supportive statements recently about the potential of blockchain and the role of blockchain, including with ETFs. I think the FinHub, that's kind of the office within the SEC that's looking at financial innovation, had its status elevated over the last few days, to become kind of a major branch of the SEC. And so I think it's moving in the right direction.
Excellent. Excellent. Do you have something, Hubertus, that you wanted to add, or?
No, I think that's perfectly elaborated.
All right. I know I've been hogging all the time with my questions. I have a couple more, and then I want to open it up to the audience and make sure that we're able to get in as many as we can. Mike, apologies. I kind of got tied up in compliance land and I didn't forget about you, but I do want to turn to you with this question. And Hubertus, I'd love your thoughts after Mike has an opportunity to answer. From your angle, given a lot of the folks in today's audience are part of the family office network, how can family offices benefit from digitization from your perspective? And Hubertus, would love your thoughts as well.
So, I've spent a lot of my career working with family offices, and I think there's two things that family offices crave. One is interesting opportunities that are kind of, a little bit off the run. So, they're not so interested in, kind of plain vanilla PE or plain vanilla equities. They own those things, but, their alpha generating team is really looking for more interesting stuff. So, things that trade on the tZero platform, have a lot of appeal because they allow them to actually play in a playing field that is, less crowded, where they can apply their skill set and really drive returns and really discover new opportunities. Secondly, and probably as important, if not more important, is family offices own lots of private businesses and often are somewhat struggling to find ways to get the best liquidity option. And so being able to utilize a platform like this that is efficient, it's transparent, relatively low cost compared to the other solutions is really a new tool in their toolbox to create value either for their family that they work for, or if they're the patriarch, the family themselves.
Yeah, I think that's good points. I think to add to that, I mean, if you look at the large companies that trade on the US stock exchange, I mean, the trading in these exchanges is mainly dominated by institutional traders, high frequency traders. And here, as you said, I mean, on platforms like tZero, you can really probably have a more, let's call it, level playing field, which is slightly more unbiased, which might be attractive for investors, not only family offices, but any kind of more private investor. But above that, I think it's really access to interesting deals that come to the market. And it's, by the way, it's not only limited to real estate. I mean, real estate ownership, you know, so far was kind of binary. Either you own a property, you don't own it. Through that, you can be part of it. But I think what we see in digital securities is not only the tokenization or the digitization of real estate, it's really also other part. It's for instance, digitization of funds, which is super attractive for LP structures who want to liquidate their positions earlier than just, you know, trading them on some OTC secondary market. That might be very attractive for private equity and venture capital structures. We could think of the digitization of art pieces, for instance. I mean, who have very interesting value generation and store of value components, and to have the possibility to exit some of this position in order to grasp new opportunities in investing. I think that's super attractive. And again, it's all about liquidity. It's about speed of transactions. And as we said before, I believe that the generational change that we are seeing is going to accelerate that process.
Excellent. No, that makes sense, and thank you for that, Hubertus. Last question before we turn it over to Q&A, and this is for all the panelists, and I'd like to start with Alan, then Hubertus, and Mike. You know, clearly the space is moving very quickly, and adoption's happening at a rapid pace. You know, I think it'd be good to leave the audience from each of your perspectives. Where do you see this space in the next 12 to 24 months, both from a private market perspective and in a digital security perspective, and how does it kind of, you know, you see it continuing to merge?
Yeah, absolutely. And look, I think you're going to see a number of inflection points over that time horizon. They're going to be supply side inflection points. So meaning you're going to see more private assets trading in a continuous automated ecosystem and leveraging blockchain. On the demand side inflection points, meaning you're going to see major investors, in particular institutional investors, expressing an interest in and participating in this ecosystem. And they're going to be infrastructure and regulatory inflection points, kind of picking up on the theme that Hubertus and I were talking about. And so, and somewhere in the second half of that 1 to 2 year horizon, you're going to start to see, you know, what I think is the inevitable convergence, both of the technology rails. So, you know, the new types of, you know, the distributed ledger technology replacing legacy systems as being the better system for moving value globally in a seamless, frictionless way, as well as convergence of public and private asset liquidity with appropriate distinctions, where the regulators still think you need to treat them differently.
Yeah, absolutely. I would totally echo that. I mean, the underlying technology is open source in most cases, in case of Tezos, Ethereum, and these large platforms, and that triggers innovation at a very, very fast pace. And these open source systems, they scale very rapidly, they improve very rapidly, and I think this is going to benefit this space a lot in the sense of what you just said. I want to bring in another perspective as well, which probably is not only for the next 12 to 24 months, but slightly longer, maybe 3 to 4 years, which is the retail point of view, right? Which is important for this whole spectrum. I believe we will see in the next 5 years that digital and digitized assets will be available through wallets on mobile devices to end users, and this will create, this 360-degree liquidity span that currently is missing. So we are still currently very much on the side of institutional investors trading on these exchanges on platforms like tZero. But once we have this other spectrum of the retail investor who has that accessible in a compliant manner through the technology and devices that are currently being built, I think then we have the loop closed, and then I think we will have a lot of dynamics in that space.
Excellent. Mike?
No, I think one of the things we'll see over the next 12 to 24 months, which I'm not a lawyer, but like many lawyers spend a lot of time in the regulatory world, is we'll see more regulatory clarity. And as there's more regulatory clarity, then there'll be more comfort for folks who've sat on the sidelines, both institutional and retail, to engage in this market. This market already, frankly, has a lot of regulation, but there just hasn't been as much clarity there for a lot of people. And so when you talk to them about these assets and engaging in this market, they're constantly asking, well, how does it work and what are the regulations? And once they hear that actually it's pretty robust, a lot of their fears drop away, but that needs to kind of move through kind of the market ecosystem. And so my sense is, we're going to start seeing some bigger folks list on these platforms. They're going to see the activity, get excited about it. That's going to create more momentum on both the supply and the demand side, as Alan mentioned. And most markets take time to develop, and the early adopters, are often very different than the conclusions. But I think what we'll see now is, a lot more activity from companies that people have heard of trying this out. And when that happens, it becomes a pretty interesting tipping point.
Excellent. Alex, let me turn it to you. I'd love to take a couple questions from the audience. If you can just read a couple off, I can help direct them.
Of course. Oops, sorry. To kick off, what are the major differences between an STO and an IPO?
Alan, why don't you take that one?
Yeah, look, I think it's probably, Mike talked about clarity, including regulatory clarity, and I think it is going to be part of, part of inflection points as we kind of get into the next 1 to 2 years. Differences between IPO and STO, right? An IPO typically is when you take a private company and you sell securities and you trade it on a stock exchange and you become a public company and you're subject to SEC disclosure rules and all the things that follow. An STO, when that term was used kind of 2017, 2018, typically meant, a company or a group of entrepreneurs selling interests that were most likely securities in digital form to the market, and typically in a transaction that wasn't an SEC registered IPO type of an offering. So you can try to think of a distinction on the basis of kind of traditional versus digital, public versus a private placement, for example. But I think again, the future is going to be where there is no distinction, and all IPOs are STOs. That's the future. Even if a legacy meeting had kind of particular differences to them that were that were intended or unintended.
Excellent, Alex.
Thanks, Alan. I think we have time for one more question. The question is, where do you see the largest near-term opportunity for secondary market liquidity?
Mike, why don't you start it off, and then Hubertus would love to get your thoughts on that as well.
Yeah, I think there's two places. I think the first is, secondary market liquidity. The place where people want liquidity and don't have it is frankly in real estate that's not in a big REIT conglomerate. So I think there's going to be a lot of activity there as both the managing partners and underlying investors seek to have liquidity. And then I think as we see some of the very, very large private companies either list on some sort of exchange or go public, there's going to be much more interest in the next layer down, which frankly, the non-unicorns, where there's actually a lot more assets to quote invest and trade in. And those, those are, you get beyond the ones you can name on a couple of hands and you start talking about lots. And so I think that's where we'll see the next leg of liquidity play out.
Yeah, and probably in addition to that, as we said before, probably the whole investment space, funds might also be interesting. I mean, currently certain funds are only available to a certain class of investors. If you could digitize that in small fractions, pending regulatory framework, obviously. You can have additional groups of investors participating in these spaces. And another area which we've seen that starts to pick up in some areas, especially in Europe, I've seen that now, is SMEs who currently are not listed and who see an interesting way to access liquidity through that platform in a cost-efficient way.
Yeah, Ashu, I would just add one thing, and this goes on Hubertus's point. Most mutual funds have a 15% illiquid bucket. They use that to often buy private equity investments and venture investments. They wouldn't do these types of assets unless there was an easy way to transact in them. So any development of that market is going to bring folks like that in, because unlike the private assets that actually are already super active in, these actually have an easy off and on ramp if they're trading on an ATS.
Yeah, I think it's a kind of a question where electric cars, right? Well, what kind of people can ride in an electric car? The answer is anyone, right? Who is more likely to buy it first? That's a different question. Obviously, as Mike and Hubertus talked about, there is some kind of judgment and perspective on that. But the answer is that this structure, both private security, liquidity, and use of distributed ledger technology, is asset class agnostic, asset type agnostic. And so I think it's, and it really is meant to move the industry to the next stage, again, across different types of investments and asset types.
Awesome. This has been fantastic. I appreciate you guys doing this. So thank you to Hubertus, Alan, and Mike for joining us today. It feels like there's a lot of great momentum and a lot to look forward to in this space. Thank you for the questions as well. Apologies if we couldn't get those addressed now. Alex, I'll hand it over to you for our final segment.
Thanks, Ashu. Our last session will focus on the future of investments and trading, led by our keynote speaker, John Jacobs. John is a senior business leader and the former EVP and CMO of Nasdaq. John currently serves as chairman of Alerian and founder and CEO of Q3 Advisors. John is also a board member of tZero, Procure Funds, and US Bank Lift. In addition to these roles, John is also the executive director of the Center for Financial Markets and Policy and an adjunct professor of finance at the McDonough School of Business at Georgetown University. John, welcome and thanks for joining us today.
Thank you very much. I appreciate it. I enjoy being here. I tell you, I'm really excited about this topic. I want to talk for a second about what attracts me to this space, and because I've done over 30 years in this space, and then and particularly what still excites me today. So I worked at Nasdaq for decades, and then have done a lot of other things within the financial services industry, and it's made my career on my passion about organizing inefficiencies in the marketplace, and that is all we're talking about today. Is inefficient markets where there's friction, is market where there's not as much liquidity, where investors don't have access. And so this isn't a question of if it's going to happen, it's happening today. I love the last panel, and I love the last couple of comments, because we talked about where we're going to see, what areas are ripe for, transformation to digital assets and more liquidity. And they mentioned of real estate and the next level down from the unicorns or the SMEs or funds. Guess what? That's all happening. It's all true. And I think 12 months from now, it'll be a very interesting conversation to see how many more things have come online and how much more of those marketplaces have had their assets put into a very efficient digital marketplace, attracted the market participants, the buyers and the sellers, and liquidity, and it just creates a very virtual cycle. So given that, I want to step back though a little bit and kind of just use some proof points to show how technology is continuing and will continue to drive the democratization of markets and how that drives liquidity. So Alex, can I have the next slide? So if you look back, and I know this one pretty well, all markets were floor-based 50 years ago, 1971, until February 1971. And they literally were floor-based. And think about the frictions and the inefficiency. You had to get a security listed in that room, and then you had to get your order in to that room via telephone or telegraph or whatever way you did it in order to buy or sell those securities. And it was very, very inefficient. However, at least those markets were more efficient than other markets. In the late 60s, the Congress looked at the U.S. financial markets and said, well, we've got this national exchange, the New York Stock Exchange for equities, and we've got some futures markets. We've got this other larger than most regional type of exchange, the American Stock Exchange, and then we've got these regional exchanges. But where the biggest hole in the whole process was the OTC equity market, over the counter, and that term's been used a lot today, over the counter securities. Alexander, next slide. Alongside of this is a truism throughout history. Investors, buyers, sellers, traders, they're always evaluating a transaction based on risk, return, and liquidity of the asset, right? And it's all three of those. You may look at an asset and it's got great return, but if you can't sell it and the liquidity is zero, what good does it do you? Is that a real return? Also, the risk of being able to not get in and out of a security without a high cost or things like that. So remember, when we talk about digitizing assets and DLT technology and all these new things, we're still not shying away from the basic tenets that you need to do when you analyze investments and trying to bring investments to the marketplace or sell assets: risk, return, and liquidity. Next. So friction in the markets. As I talked about this, inefficient markets have friction points that create cost to buyers and sellers. I teach a class for 7 to 12th graders, and I do it online, and I talk about the difference between savings and investing, and I start off with liquidity. What's the most liquid? Cash. You know, what are the risks to cash? Lose it, or some other thing. What are the, and then as we start walking up the hierarchy of investments and places you can do that, we talk about how easy it's to turn into cash, how expensive is it to turn into cash, right? So remember, friction costs create cost. Friction creates cost to buyers and sellers. Technology is not here. People don't apply technology because they just like to play with the newest technology. Technology advances financial markets by reducing friction and bringing in buyers and sellers. So floor-based markets we talked about, and I'll talk a little bit more about that in a moment. Let's talk about settlement times, because one of the great things about DLT is immediate settlement. I've been around a long time. I was in the industry just after it switched from T+5 to T+3. And a lot of people most likely were not aware that the stock market used to close at 3 o'clock on Wednesdays or 2 o'clock on Wednesdays just to catch up on the paperwork and trying to get, you know, securities into the right accounts and cash back into the other accounts. So settlement times were critical. And the first thing they noticed as they automated the back office of Wall Street was that, and reduced the settlement times, is people felt more comfortable recommitting their capital. It poured more liquidity back into the marketplace, and we just saw liquidity increase, valuations increase, and made more fair. And then we saw, again, people recommitting their capital and volumes going up. Again, more buyers and sellers for securities out there. So we recently went from T3 to T2, and if it wasn't for the infrastructure of Wall Street, we could go to tZero, but they're working on it, and it will be there one day. But that's the advantage of these new digital markets like tZero, is they're there today, right? So fractions and decimals, that was another one. When I started, everyone traded in eighths and sixteenths and all sorts of fractions of doing that math in their heads, et cetera, and wider spreads, put more money in the pocket of the market participant than it did in the investors, and so on and so forth. And moving to decimalization, which was a massive transition on Wall Street, resulted in much tighter spreads, much less expensive trading costs, much more reduced the cost of trading, et cetera, and those benefits were passed on to the ultimate consumer, the investors, and drove up liquidity in the investments. Next, please. So, as I said, in 1971, all stock options, markets, futures, et cetera, were all based on a physical floor. Coming up next year, Nasdaq's going to have its 50th anniversary in February 1971. And again, Nasdaq wasn't envisioned to be what it is today, one of the largest stock markets in the world. And actually, Nasdaq owns like 30 or 40 markets around the world and all the things it does. It had one purpose. Can you organize OTC equities? And very similar to today in certain asset classes, those pink sheets of paper right there were called the pink sheets. That was OTC markets. And the rules were you pick up a phone as a broker and you had to call 3 other people and try to get the best price from 3 different phone calls to call and get the best price to buy or sell, whatever you're trying to do. That's it. If the 4th call would have been a better price, too bad, you didn't make it. And if the first call was a better price and by the time you got back to him, his price moved, again, too bad. Very inefficient marketplace. And by the way, I visited the National Quotation Bureau once in the 80s, who published the pink sheets. And it was a factory in New Jersey, and literally the entire place was covered in pink dust because of all the sheets, pink sheets of paper. And they publish this and deliver it every day to the trading desk, okay? So what Nasdaq did, and there's the first Nasdaq trading terminal on the right, is they just basically created a bulletin board of all these securities. So you could look on the screen, and the market makers, instead of picking up the phone to call them for a quote, you could see it, and it ranked them in order, and you could pick up the phone and call them. You couldn't trade on this, but it sped up the system tremendously by letting brokers compete to get their name at the top of the list. So you pick up the phone, call them, and trade. By the way, little side note, Nasdaq made its money by how many times you hit the keys, and the keyboard was not a QWERTY keyboard, it was an ABCD alpha order. So if you knew how to type, it really was a hard adjustment to go back. But anyway, next slide. So the history of markets, I'm talking more like equity markets, are fixed commissions ended in 1975, so there was competition among the brokers, right? No more, the store used to be rich guys selling stock to other rich guys at a fixed commission. Now it was competition. Charles Schwab and the birth of the brokers that didn't require a fixed commission. A lot of you also don't realize for the first 200 years of existence, the New York Stock Exchange did not list IPOs. All the listings they had on the New York Stock Exchange were direct listings, i.e. they had to be seasoned somewhere else for 2 years. That was OTC, then Nasdaq, then an Amex, maybe a regional exchange. So 2 years they had to trade. So there was a tremendous amount of missed liquidity opportunities. The other thing that created though was the birth of the modern IPO. So that with a Nasdaq trading terminal and a Nasdaq underwriting syndicate, companies going public on Nasdaq, that underwriting syndicate became your trading that brought in did the research and brought in all the buyers and sellers, and so you saw the birth of the modern IPO, which we're still enjoying today. So it was a very interesting thing. Again, these were all just inefficiencies in the marketplace that people seized upon and said, let's make it more efficient. Let's make it more effective. Next slide. So, and let's look at the CME. I talked about Nasdaq. Let's talk at the CME. So the CME started off as a butter and eggs contracts back in the 1898s, and then they started the CME Globex platform in '87, and then the futures trades are made on CME, the Globex electronic trading platform. The E-minis were phenomenal products. The E-mini S&P 500, the Dow contract. I launched QQQ. I created QQQ on March 10th, 1999, NASD owned Nasdaq and Amex at the time, and I launched a fund family with the Nasdaq to launch the Qs. On the day I launched the Qs, I also launched a Nasdaq 100 option on the Amex, a Nasdaq 100 ETF, they didn't call them ETFs, the QQQ option on the Amex, and 3 months later, we launched the E-mini Nasdaq 100s. Those 4 products have been one of the most successful suite of products ever launched. If you look at the trading and the amount of investment that is tied to the Nasdaq 100 index, I think it's close to 19,000 contracts or different types of products, and the Qs are trading at billions of dollars in assets, et cetera. But I think the point is, it's all these products brought more liquidity, more investors in, so that you had trading on the same basic thing. You could now attract my mother, who was bought QQQ on the day it was launched, 71 years old, all the way through, and by June, the most sophisticated traders who were trading futures products on the Nasdaq 100. Again, driving liquidity into the asset. And then all the way up to, CME launches Bitcoin futures. So anyway, the CME has followed a similar path around for, a long time, close to 100 years before they really started to apply technology. But now they're just right in the thick of it and driving forward, and look how successful they've been. Next slide, please. So the London Stock Exchange, also, like every other market, used to be physical floor. The picture on the left is what it used to look like. They modernized it, spent this money, built these brand new trading kiosks, etc. And boom, in 1987, they went to the big bang and said, you know what? If you don't want to come down to the floor and you want to work from your office and just, do your trades automatically, you can do that. And that is what it looked like, the big bang. Same thing that Nasdaq did, same thing that that other exchanges and every other exchange has now gone through, is that if you allow electronic trading, you're bringing in, casting a wider net, bringing in more investors, buyers, and sellers in a much more efficient manner. You don't need to stand face to face to trade a security. Next slide. So I've talked a lot about stocks and futures and options, et cetera, but this happens in other areas too, right? So again, everyone looks at eBay today and says, wow, it's a massive company doing what it does. eBay was a very, interesting start. It was built around two different assets, essentially. Beanie Babies, for those who remember, and, jeans. And that's what the market was built around. It was a way to buy and sell those kinds of things, organizing markets around those two particular assets, and then it grew. We all remember that Amazon was built around books in the beginning, and what really drove the early success of Amazon was the Harry Potter series, and then DVDs. People may or may not remember when Netflix was actually a DVD delivery service as opposed to a streaming service like it is today. Uber was just going to be a more efficient cab in San Francisco. Groupon, let's come up with one deal a day in Chicago. So it's definitely a local company doing one type of deal a day. All these companies pivoted once they realized that as they built these markets around specific assets, that it attracted buyers and sellers who then wanted other assets, who then wanted other things to trade. And once you gave them the self-directed idea of what they could do, look how these markets have grown today. They're tremendous markets, okay? And again, it is very basic tenet. Let's use technology to bring in buyers and sellers who then can trade a variety of different assets. It's very simple. Next slide. So today's markets, as we said, are organizing around the globe around every single type of asset. So we talked about the example in the first presentation was the real estate example, and there's others out there, digital assets. Obviously, people know about cryptos and things like that, but it's every asset. And I think, again, the last comments made by the last panel about real estate, about funds, about, not the unicorns like the Ubers and the Airbnbs, but the companies below that, or the small and medium enterprises. Those are all asset classes that are having markets develop around them today. And assets, the class that were thought to be traditional, everyone thought real estate is physical, it's traditional, it has to be done a certain way, you put a sign out front or work through an institutional broker, something along those lines. They are converting to digital form today, and that pace is accelerating. But the basic reasons are you're bringing in buyers and sellers, you're adding transparency, you're democratizing the asset, you're allowing people to get in and out, it drives liquidity, it drives the ability to invest, all the things that go back to the basics of investing 101. So newly organized markets like tZero, which is why I joined the board, tZero are organizing these markets, and they're bringing the buyers and sellers together. Buyers and sellers don't just bring liquidity, they bring information. And then information brings other buyers and sellers, other market participants, and that brings more liquidity. So it's not just about the ability to trade, it's the ability to trade with knowledge, or the idea that you're seeing volume on the buy side, volume on the sell side, the price is moving up, the price is moving down. All that is information. And at the end, we're coming right back to where we started, which is liquidity information drive better risk, return, and liquidity profiles. So this isn't new. It's been around since, ancient markets organized rather than, the guy in his one farm with pigs, another farm with cows, and they meet in the central marketplace, bringing assets to a marketplace. So it's been around for a long, long time. It's just today it's happening through digital assets and organized markets that are all fitting within the regulatory framework, right? And the other thing I want to point out, which I think is very important, we talked a little bit before about Reg D and Reg A and Reg S, et cetera. None of the things we do here preclude you from, or preclude anyone from doing the ultimate IPO at the end of the day if they wanted to, or direct listing and things like that. So it's not that you're closing the door and saying, well, I'm not going to go public, I'm going to do this. What you're saying is, this is how I'm going to raise capital today. This is how I'm going to help my current investors exit and new investors come in today. But it's also setting the groundwork for going, for being able to attract more and more investors. You go we said the retail food chain, and do your IPO on Nasdaq or the New York Stock Exchange one day. You can still do that. We're not closing doors. What we're doing is we're building a better groundwork and giving you better valuations and better access along the way. So it is not a matter of if, but a matter of when this is going to happen. Next slide. So, and again, this is interesting. We at Georgetown, we had a conference a couple of weeks ago or a month ago. It was our every annual financial markets quality conference. And Stacey Cunningham, president of the NYSE, was on, and she was chatting. She said one day they listed 2 SPACs, 2 direct listings, and 1 IPO. So in the past, and this is a very robust year, in the past that would have been a traditional IPO. A lot of companies would do on Nasdaq or the New York, and all of a sudden we've seen the SPAC, new version of the SPAC has become a very popular way for companies to go public and raise capital that way. And then direct listings, where companies are just taking their already created assets and just registering them and putting them in the marketplace, and then opens the door for all sorts of follow-up transactions. But so although there's a huge, robust IPO market and capital formation market on Nasdaq NYSE, a lot more activity is happening off those exchanges. Companies are staying private longer. The Jobs Act back in 2000 changed a huge amount of the rules and didn't force companies to go public. I was around at Nasdaq and listing Google when Google was forced to go public because they hit the shareholder threshold of having 500 shareholders, I think it was, and a certain number of assets, and they had to go public. The Jobs Act changed that. They don't count employees anymore, because every Google employee who had shares counted, and so it's changed that number greatly and changed that. So companies are staying private longer, and as you see, and going public at a much higher, larger size. But it doesn't mean they're not doing capital formation in the interim, right? They're doing founder capital, they're doing venture back, they're doing private equity, and what they've had to do is they're ending up managing their own capitalization table. They're being their own market maker. They have a round of investors that are invested in the company. Somebody says, look, I need to get out. I want to, my profile's changed. I want to liquidate this particular asset. There's no market for that, or wasn't in the past a market for that. Now they have to go to the company and say, hey, do you know anybody who wants in? And the company acts as their own broker dealer, and they're trying to figure out who they can get in. So what tZero is trying to do is building is a regulated secondary trading venue, right? So it's the idea that this is just like, the IPO market for Facebook. It is the secondary market, regular secondary market for, a private asset. And again, as I said, it does not preclude a company from pursuing a public offering in the future. Next slide. The other thing I want to leave you with is there is a first mover advantage, right? The first assets to take advantage of a platform typically become the market leaders in those areas. They will, in the financial markets anyway, and they will, gather the most liquidity because that's where people go to first, et cetera. So markets organize around you, right? Liquidity coalesces around you. Information will center around you because it defaults to what's visible, what's transparent, what's accessible. So if you're contemplating this, I advise you to reach out to those people and start talking to the people who are in the business of creating digital assets. You can walk you through that process, because they will help you get to the point where you can get out there and start accessing investors, buyers, and sellers. It won't happen by waiting for people to come knock on your door. I think you need to be proactive here. As we say in Wall Street, we're in the financial markets, assets are sold, not bought. So I think, Alex, with that, we'll turn it over for questions.
Thanks, John, for the insightful discussion on the future of investments and trading. As John mentioned, we're going to open it up to our last Q&A session. To the audience, please feel free to submit your questions to John or the broader group through the platform's questions widget. All right, John, to kick off the first question, do you see the importance of exchanges diminishing if similar levels of liquidity can be achieved on an ATS?
No, I see it as a going along the pipeline, right? I still think the exchanges will have a role, but put it this way, I think it just changes it, right? In the past, it was the New York Stock Exchange by itself, and now there's Nasdaq and the New York Stock Exchange and CBOE, et cetera. But no, I don't see, I see basically the ATS is taking their rightful place in the food chain, right? Providing those assets and those things. And as I said, somebody may move from a private asset and private company and then move on to an ATS and decide later on I want to get the full, panoply by, listing on a market like Nasdaq. You don't have to go all the way up the food chain if you don't want to. There'll be plenty of liquidity built in the ATSs. So I don't see them replacing each other, but I do see it as a continuum. And where you are as an issuer or where you are as an asset, you'll figure out where you belong on that spectrum.
Thanks, John. Another question for you. Do you see enabling secondary market liquidity on the tZero ATS or a competitive platform as an exit solution similar to how companies currently view an IPO?
Yes, absolutely. I do believe that the two things that you're going to do on a platform like tZero or others is you're going to be able to do secondary trading, right? And you're also going to be able to do capital formation. You're going to be able to raise capital. So those two things together allow an exit strategy. It may not be an exit strategy for the investors of 100% of their holdings, but there will be. So the whole point is allowing a owner, whether it's a founder owner or whether it's someone who's an investor, to exit out of this particular investment and then redeploy their capital into another one. So yes, it is going to be a very liquid, information-driven, transparent platform.
Thanks, John. We have time for one more question. How big do you think this new market will be? Do you think tZero is well positioned to be a leader?
Absolutely, that's why I joined. Two reasons. One is they're doing it right. They're dotting every I and crossing every T. I was one of the original officers that signed the application to the Securities Exchange Commission in 1999 for Nasdaq to become an official exchange. Nasdaq was launched in '71, approved by the SEC, and was considered a regulated securities market, not an exchange, because we were still designated as the OTC section. It took 5 years for Nasdaq, and it had been trading for 28 years under the guidelines of the SEC to become a market. So I know what it takes to follow the rules and build out a successful ATS, an successful marketplace, et cetera. So that is what's necessary here. There are no shortcuts here, right? And luckily there's blueprints. So this is gonna happen so much faster in this marketplace. And but I do believe, absolutely believe that tZero is on the right path, which is why I'm so excited to participate.
Thanks, John. As I mentioned, we've received a number of questions today. If we were not able to address your question, our team will follow up to share additional insight this week. If you have any questions you're not able to ask today or would like to get in touch with tZero to learn more, please feel free to reach out to tZero's business development and capital markets team at sales@tzero.com, and they will either answer the question or pass your inquiry along to the appropriate party or speaker at today's event. I want to thank you all for joining us on today's webinar, and we look forward to continuing the conversation. Thank you all.
Alex, thank you so much. To the tZero team, thank you very much for presenting for us today. We hope everyone has a great day, and we look forward to following up with all of you. Thank you.